Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Alexandra Canal, and we've got a pretty crowded 2 hours for you here. Let's get you up to speed on the market action because we're still looking at a mixed picture. The S&P and the Nasdaq both under pressure following some disappointing earnings results that we've gotten over the last 24 hours. Also, a unexpected drop in jobless claims that is weighing on the market here. The Dow, though, eking out gains up just about 200 points here. Taking a look at the 10-year yield, we're seeing the yield push higher amid some of the concerns that the unexpected drop in jobless claims that might make it more likely that the Fed is going to stay aggressive. You're looking at the 10-year yield up just about 11 basis points. Well, Ali, let's talk about some of the earnings results that we've gotten over the last 24 hours. It all started out after the bell yesterday when we got the results from Tesla, when we got the results from Netflix. Didn't exactly match expectations, investor expectations. We are seeing that reaction in the stock today. Those two names, the top trending tickers on Yahoo Finance, and then it carried throughout this morning when American, their guidance fell short of what the street was looking for when it comes to third quarter sales. And that was enough to push that stock lower today, too. Yeah, across the board, guidance seems to be the biggest issue here. And it's interesting to see earnings per share be pretty heavily for Netflix, Tesla, and American Airlines. And yet we're seeing stock reactions that are pretty bleak right now. I mean, look at Netflix down more than 8%. After that earnings report yesterday, it was down 8% as well. So we're seeing these declines. And I think part of the story here is that we're in a very overheated market right now, especially when we talk about some of those tech names like Tesla, like Netflix. I also think expectations heading into this report were incredibly high, that if you're not beating by a significant portion, you're going to see that immediate impact in the stock price. Yeah, United was one of the names that was able to satisfy what the street was looking for, and we're looking at gains there of almost 3%. You mentioned the fact that it's all about guidance and also the bar that has been set for companies heading into this earnings season. When you take a look at D.R. Horton, the home builder, that stock is actually under pressure today, but they met the street's expectations. And I think a lot of it, to your point, is the run-up that we've seen in so many of these individual names since the start of the year. Investors want to see pretty solid beats. If anything comes in maybe just in line with expectations, it's not enough. And we're seeing that reflected in stock prices today. D.R. Horton off just about 2%. All right, let's dig into the best ways to play the markets this earnings season. We want to bring in Ken Mahoney, CEO of Mahoney Asset Management. Ken, it's good to see you. So first, let's just talk about your overall takeaway with earnings, because the bar has been set low overall when we're expecting this drop in profit for the quarter, and we're seeing the names already not meet expectations. What does this signal about the moves we'll likely see in the coming months?
Yeah, it's funny. We sometimes come limping into earnings, the bar is low, and we get some pretty good reaction. On the other hand, we come in hot into earnings, which we are, expectations are higher, and there's that disappointment selling news that we saw with Netflix and Tesla last night. So I've seen these cycles before. We are coming in pretty hot into earnings, set the stage for selling news, unless somehow it can just totally blow out the expectations going forward.
And Ken, you're also pro-growth over value. Historically, we have seen growth outperform value as we head into a recession. So how much of a recession risk does that factor in your calculus when you're more growth over value?
Right. So a lot of it's kind of bottoms up, looking at company by company, looking at growth, and then you end up with this kind of big tech, so to speak. We've been hearing about this recession, and it probably will happen at some point. The inverted yield curve, the 10s, the 2s. I've been hearing about this for almost a year now. And, that bearish argument, and why it may be sound, it may happen, the opportunity cost is pretty immense, sitting on the sideline waiting for that. So we're still in that fast lane. We're still in that growth lane. We're still in that AI lane. We understand there's bumps and bruises there. But certainly we don't want to be overly bearish, because at the end of the day, you can make all the arguments you want. The final arbitrator is price. And since October, at some point, people point towards January, we've been making higher lows, breaking through resistance time and time again, and we have to look at price.
Ken, what does the upside potential look like for the market? You mentioned the fact that maybe some of the leaders that we'll see in the second half of the year weren't necessarily the leaders in the first half of the year. But when we take a look at the S&P right above 4,500, what is that upside? Is there much upside potential from here?
Look, I think you probably first have to go back and fill a little bit. You see today a rotation when people say, hey, stocks are down. Like, not so quick. JP Morgan hitting a year high. You have energy stocks. Exxon I saw up earlier today. So you're seeing some money coming out of tech, which makes sense, rotating into some areas that are kind of lagging, again, the very hot Nasdaq index. But I think going forward, yeah, I mean, probably when they say easy money, there's no such thing as easy money. But the Nasdaq, it's going to be pretty hard to duplicate what happened the first half of this year to the second half of this year. But I do think investors should have a balance. I think the risk reward is now kind of equal. I do believe last October, January, it did favor investing because you already sucked the air out of the market. You already had the risk that happened. So I think right now it's kind of equal weighted where we are in the marketplace right now.
And Ken, the Fed set to meet Tuesday and Wednesday. Another rate hike is likely to come. But is Jerome Powell's path to 2% inflation worth the risk to the economy? You say it's not. Why do you think that's the case?
Look, I think it's foolish, but like that ship has sailed. That 2%, we're not going to see that for some time. And what is the damage from bringing inflation, let's say in the high 3s, low 4s, down to 2%? How many people have to be laid off to kind of play this little game of the Federal Reserve? And that's my concern, is that some people, they don't mind paying a little bit higher prices, but they have job security. But if the Federal Reserve really wants to break something and really want to break something, you keep keeping that 2% target, and we will start breaking it. We'll start breaking the labor market. And I don't think that's right to be playing games with people's lives.
Ken, what should be the target? What should the Fed be satisfied with?
I mean, at this point, I'm in the 3% camp. I think we all can live with it. That ship has sailed at 2%. Be nice to get there, but to use so much of a wrecking ball to get there, I think 3%, I think most people can live with, and still have a tight labor market or a strong labor market with 3%. I think we all can live with that.
And Ken, let's say the Fed does continue to raise rates and we do enter this period of economic destruction. What do you think will be the biggest thing to get hit? Is it that labor market?
I think the labor market, of course, REITs will get hit, equities will get hit, pretty much any risk-on asset class will get hit with that. And it's also the uncertainty of the path, because most people thought, like we were telling clients, we're in the 8th or 9th inning of the rate hike cycle, right? Rate hikes. And here we are in extra innings. I know 10th inning, 11th inning, still kind of quarters and so forth. And quarters can add up if you keep doing this. So I think the Federal Reserve should just kind of stay cool a little bit. The direction from, look where we were last year this time, 9.1, 9.3% CPI. Now we're in the high 3, low 4s. We're going in the right direction. So I really don't know what their haste is all about.
All right, Ken, let's get some individual names for you. You've got 2 names to buy, 2 names to avoid in this economy. I want to bring back in Ken Mahoney, CEO of Mahoney Asset Management. Ken, let's get right to it. With your first pick, it jumped out to me, and that's Palantir. This is a stock that has had a massive run up. Yes, it's been volatile, but it's up 170% since the start of the year. Some on Wall Street are cautioning right now, saying it's not the time to jump in, but you see more upside potential. What's the catalyst?
So the catalyst is government contracts. This doesn't really get all the buy ratings and strong buy ratings because of the way they came public. They didn't go through investment banking. They kind of did direct. So they kind of snub Wall Street a little bit. So they don't get all the love. But it's contract after contract. They hit a high yesterday at the open at 19, settling down around 17. Look, the runway, by the way, next month is the earnings. We don't like to hold a lot of positions overnight to earnings. Example, Netflix and Tesla. But we do think there's a little runway here to make some money. We think it's exciting longer term once we get past this earnings season, because again, it could be sell the news. But Palantir looks like in good shape. A good way to play AI outside NVIDIA, Microsoft, the obvious ones. This one makes a lot of sense to us.
You also like Pacer US Cash Cows 100 ETF, ticker COWZ. Now, this ETF has a lot of exposure in oil and energy. What's the bull case there, especially with geopolitical risks like the ongoing Russia-Ukraine war?
Well, I always feel like there's some type of Saudi put or OPEC put, which anytime we get below $70 a barrel, here they come cutting, a million here, a million there. Our strategic reserves are very, very low. And again, we've had such a red hot first half of the year with tech. Again, I do believe some of that money will rotate into energy that's been off, or rotate into banks, which has not been all that exciting as of late. So with cows also, though, you do get Apple in there, Cisco, companies that have great cash flow. That means they're doing pretty well in this environment. And with that cash flow, those companies are actually buying back stock, they're raising their dividends, in some cases doing both. So you get pretty much a nice diversified blend, value and growth, with companies that can really grow their cash. And again, that really favors shareholders when you can buy back stock and raise dividends.
Ken, on the flip side, you've got a couple of warnings here for investors. 2 stocks that you're saying stay away from. Both are telecom giants, AT&T and Verizon. We know, obviously, that Journal report recently calling out the fact that so many of these cables that the telecoms giants left behind are covered in toxic lead. We've seen a massive sell-off since that report, but what does that downside look like?
I still think there's more downside there until it just, look, at some point you want to go back and revisit when it starts making higher lows. But if you look at it, it's still a downtrend. And when these type of things pop up, think about OPEC, Valdez, and some of these other major stories, they don't just get written off after a couple of weeks. They hang, they linger. And next thing, investors are sitting in quicksand with AT&T, Verizon. Again, the reason I pick those is that they pay high dividends. They look very, very attractive. And maybe they'll get a good turnaround. Maybe they will get higher lows. But at the moment, until they break the downtrend, again, I think it's a sucker's bet because I do think there's still more, unfortunately, that come out of this negative sentiment, especially we're talking about lead poisoning. And you don't just clean that up in a couple of weeks and get off the front pages. They're going to be in the front pages for some time.
Yeah, and besides those unfortunate headlines surrounding the lead cable situation, are there other fundamental risks you think for these two companies?
Well, they do have a lot of debt, right? So, and look, I've always been in belief instead of having an 8% dividend like AT&T does, just cut the dividend a little bit, pay down their debt, get rid of some, diversify some of their holdings and so forth. So the risk is actually, when you look at a chart and you see it going down in a strong market, you know there's a lot going on. But I would say one thing that keeps coming up about Verizon and AT&T is the debt load that they have, the covering of the dividend, and believe it or not, if they cut the dividend, the stock may go higher because it could give them more breathing room.
All right, Ken, thanks so much for sharing that insight. Always great to get your perspective. Ken Mahoney, CEO of Mahoney Asset Management.
Thank you.
It's a mixed day for markets, but one area under pressure are the mega caps. Jared Blickery is here with a closer look. Jared, what are you watching?
Well, just take a look at the screen here. The left half is all red, and the right half is about half red, half green. The mega caps definitely under pressure. The interest rate structure, we've had longer term rates moving up today. Typically that weighs on the mega caps and some of the growth stocks more than the other, like the cyclical and the value. And in addition, we have the US dollar heading higher. Now, here's the sector action for today. Healthcare, utilities and energy, those are all up more than 1%, healthcare up 2%, but you can see the three sectors most in the red and underperforming, those are the mega cap sectors. So we have communication services, we have tech, and we have consumer discretionary. So let me show you one thing that's happening. This is a ticker that I've had my eye on for a few days. Siri. Now this stock is in a definite short squeeze. I don't have any news here specifically today, but here's what's been happening. Multiple volatility halts. Here's a 2-year look at Siri, and you can see, wow, what has happened over the last few days, couple weeks here. But you take a max chart, and guess what? I'm going to make this into a line chart, and you can see, well, what does this look like? This kind of looks like Carvana, except it was peaking back in 1999. Carvana peaked over the pandemic. So just a word of warning here. If the stock is down 99%, decent chance it's not going to recover. Here's Citigroup. This is a stock that peaked in the global financial crisis. It is still down about 90% from that peak, guys.
Some great cautionary words there. You never want to jump in maybe on a stock that's down so significantly or make it a smaller portion of your portfolio. Jared, thanks.
Exactly.
Well, we are just getting started here on Yahoo Finance Live. It has been a strong earnings season so far for airlines, but American Airlines shares are sinking today, now off 6%. We're going to take a closer look at what's behind the decline. Plus, mortgage rates fall, but inventory concerns still weighing on the real estate market. The latest housing hurdles coming up. And the Fed launching its long-awaited FedNow payment system, and it could mean that your paycheck will clear faster. That and much more when Yahoo Finance returns. Just under 45 minutes to go until the closing bell. This market check sponsored by Tasty Trade. The Dow still holding on to gains up just about 181 points, but S&P and Nasdaq trading to the downside. The worst performing sectors of the day, consumer discretionary, communication services, and technology leading those declines here, with the Nasdaq off just over 2%. A couple of disappointing earnings results after the bell yesterday and before the bell today, weighing on the major averages. And taking a look at the VIX, that's moving to the upside right now, up just about 2%, right above 14.
Shares of Taiwan Semiconductor falling today on the heels of the company's second quarter earnings. The chip giant reporting its first profit decline in 4 years. Yahoo Finance's Dan Howley joins us now for more. Dan.
That's right. We're looking at TSMC, and essentially what's going on here is a shortfall as far as the smartphone side of things. You know, we've been talking about for a while this kind of slowdown in the consumer market as far as laptops, desktops, and smartphones. And it seems as though companies that use TSMC for that technology are continuing to suffer from a shortfall. One of the largest customers for TSMC is Apple. So you can kind of try to read into what this means for Apple's iPhone sales in the quarter, though obviously it's a larger company, TSMC, and it doesn't just rely on Apple solely. So, you know, the slowdown may or may not have to do with that, but it's worth keeping in mind as we look to Apple's earnings in the coming weeks. And so basically, we have the consumer electronic side of things and then the AI side of things. And so there's been this huge ramp up in AI activity. NVIDIA obviously is a client of TSMC. And so, you know, we're talking more and more about how AI is going to be this boom for the semiconductor industry. And it is. At the same time, though, it's being dragged down because of the slowdown in the consumer market. So it's kind of, you know, we're winning on one side and failing on the other. And until the consumer side of the market starts to turn around, you really won't see that massive benefit from the AI boom reflected in the revenue numbers. So I do know that Gartner recently did a survey, filed a report saying that the slowdown in the PC side of things is starting to look like it will turn around, that we're getting towards the end of the declines, though we might not see it return to full growth until 2024, around that time frame. So for TSMC, for other chip makers, it doesn't mean they're quite out of the woods yet.
Yeah, certainly a lot to watch in this sector. Dan Howley, thanks so much.
We're watching shares of airlines, American and United, on the heels of earnings. Both airlines beating the expectations from the street and also raising their guidance. But the stocks today moving in opposite directions. American Airlines under pressure, off just about 6.5%, as Wall Street had even higher expectations going into the quarter. Joining us now for more, Savi Saeed, Raymond James Managing Director. Savi, it's great to speak with you. So that modest outlook from American, that's one of the big reasons why we're seeing that stock under pressure today. Was it American Airlines? Was that report almost a reality check here for the industry on the heels of the extremely strong results that we got from United and Delta last week?
Yeah, I think for American, the issue is, it was a really good outlook and guide. The top line outlook for 3Q23 was a little softer than what we were expecting and what the street was expecting. And so I think that is just adding to fears of pent-up demand going away or a recession around the corner. And so it's not giving people confidence in the domestic market. And they're chalking up, the good guides at United and Delta to the strength in international. So I think that's what's weighing on American and the shares in part today.
And it's an interesting story, too, if you look over long-term share price action, because despite the demand that we've seen, the positive data, if you take a look at a 5-year of United, Delta, and American, they're all significantly down. American is actually down more than 50%. So what do you think it will take to get investors back on board to the levels that they once were at?
Yeah, I think partly, with United and American, the one thing we have to keep in mind is there was some share dilution there. But beyond that, I think what is important is confidence of the sustainability of the current earnings projections. And again, if there's a fear that you're heading into a recession, I think people aren't just willing to give the same multiple as they did before. And so I think we just need to show that, that there isn't this kind of demand cliff that's going to happen with especially the domestic consumer. And I think as you gain more confidence in that, I think you'll start to see the shares improving as well. So, because from a profitability or 2023 guide, I think they're already showing good resumption of profitability.
Savi, how much pricing power do airlines still have? Because yes, we have seen airfares cool a bit on a year-over-year basis, but still air travel, air tickets are much higher than they were pre-pandemic.
I think there is, I think a lot of things are more expensive versus pre-pandemic. And so I think that's what you're seeing on the airline fare side too. Even the jet fuel, it's not as high as it was last year. Last year was double 2019. Now you're about 20% above 2019, but you're still at prices that are above 2019. So I think part of this is just the inflation that you've seen globally. And the other part of it is you did have a lot of fleets that were retired. You have Boeing and Airbus that are having difficulty delivering new aircraft. And so there is a real supply shortfall relative to demand that has come back very strong and back to kind of trend line levels. So for that reason, I think there is pricing power here. And then you have a lot of costs that are going up that will, I think, keep those fares relatively high, which is what you're seeing today.
And speaking of some of those costs, on the earnings call this morning, American did say it was committed to matching United when it comes to those pilot wages. How do you see those negotiations going, and what could that mean from a margin perspective?
Yeah, the American pilots are already getting about a 21 pay increase with this new contract. It's really making up for the fact that, you were supposed to have contracts, early 2020s. And the pandemic got in the way. So you're making up for a few years of not getting pay increases. If they do match United, it's another 1% to 2%. So relative to what you are matching today, I don't think it's a significantly higher increase. So I think their 2023 guide isn't going to be significantly impacted by anything that they're matching with the United contract.
Savi, one of the themes that we've heard from a number of airlines this quarter, and also we started to hear about it last quarter, was the pent-up demand for international travel, and international really being a standout, especially in this quarter's results. Do you see that accelerating into 2024?
I think what you're seeing this year, if you remember international, the testing requirements really only came off in kind of the June timeframe. And so what you're seeing this year is last year, a lot of people were still taking domestic or near international trips because that's where they could go easily and conveniently. And so this year, you're finally starting to see both on the leisure and business side, more of those trips being taken internationally. So it is a little bit pent up in that you're catching up for some of that, but it's also kind of diverse. You're getting some of the trips that was in the domestic market shifting to international. And I think so we start to really kind of lap that maybe late this year because even though the things were lifted, I think you really only started to see international come back in a big way in kind of that late 2022 timeframe. So I think we still have another quarter or a couple of quarters of good international momentum.
And on that international side, we're seeing extreme heat in Europe right now. Summer is usually a time where everyone wants to flock to Europe. So do you think those temperatures and what's happening overseas, could that potentially impact any earnings heading into next season?
Yeah, I mean, it's definitely, there are a lot of things going against operating a good airline. The heat being one of them. There's air traffic control issues everywhere, and in Europe you do have a lot of industrial action as well, and so I think airlines are taking that in stride and making the adjustments because they do want to run a good operation because that's the worst thing that can happen from a demand perspective is if passengers don't appreciate or don't have a good experience, they're not going to continue flying. So you are seeing them tactically and strategically responding to some of these challenges. And it's not something that some of this will get better. ATC staffing should improve as time goes on. But some of it, like weather, is something that's here to stay and that they'll have to continue to adapt.
Well, I'm trying to plan a trip to Europe in the fall, so hopefully things are good then. But Savi Seth from Raymond James, thanks so much for joining us today.
My pleasure.
Coming up, mortgage rates down this week as homebuyers get a bit of a relief, but we're not out of the woods just yet. More on the latest housing hurdles when Yahoo Finance returns.
Warner Brothers' Barbie has fans buzzing, but it's much more than just a movie to Mattel. The company is betting big on Hollywood, with several movies based on its toys already announced. Here are some of the top films in the works. Polly Pocket. Lena Dunham is planning to write and direct, while Lily Collins is set to star as the famous Micro Doll. Hot Wheels. J.J. Abrams' company Bad Robot will reportedly produce the film based on Mattel's toy car brand. Thomas the Tank Engine. Set to be directed by Quantum of Solace director Mark Forster, the movie will be a mix of live action and animation. Rock'em Sock'em Robots. Vin Diesel is set to star in a live-action movie based on Mattel's two-player action toy. And Viewmaster. MGM and Mattel are reportedly teaming up to produce a live-action movie about the Stereoscope toy. If Barbie or any of the Mattel films want to be the queen of the box office, they'll have to take down Hasbro's Transformers, the highest-grossing movie series based on a toy franchise.
Wheat prices pulling back from earlier highs as Russia issues a new threat to ships heading to Ukrainian ports, and it's sparking fears of a global food crisis. Yahoo Finance senior columnist Rick Newman joins us now. Rick.
Hey, Ali. So here we go again. Russia now says it is pulling out of this deal that it joined last year, which allows Ukraine to export grain through its ports on the Black Sea. It's a reminder that we should not look away from this war. This can blow up at any time in ways that affect global markets. So basically what seems to be happening, Russia has actually said that any ships now headed to Ukraine's Black Sea ports, they will consider them to be carrying military equipment. In other words, they consider them to be targets and they could blow them up. And now Ukraine has said, oh, well, we're going to consider any ships heading to Russian ports in the similar area also that they could be carrying military equipment, and maybe we'll target them. And Ukraine does have naval drones that can sneak up and blow up ships. So this is a direct threat to all that shipping of agricultural products. And what is kind of going on behind the scenes here, probably, Russia is actually the world's largest exporter of wheat. And prices have been down because supplies have been stable. So Russia is basically kind of pushing a competitor, Ukraine, out of the wheat market, and that is pushing up prices. So Russia's actually going to be able to charge higher prices for its wheat. So this is actually a kind of a form of economic warfare that is accompanying the military warfare inside Ukraine.
And that makes sense in terms of why Russia's doing it, why this would be advantageous there for them in terms of the prices. Rick, with the war escalating between Russia and Ukraine and the fact that the prices have been under pressure and Russia decided to do this, the odds of getting some sort of export deal in the near term, is that pretty much off the table?
Nobody knows. This gets back to trying to get inside the head of Russian President Vladimir Putin, and nobody quite knows what he's going to do next. Many things have not gone anything like people expected with regard to this war. It is worth pointing out that Russia made threats last fall to pull out of the grain deal, and then they ended up staying in it so that the exports continued to flow. So that could happen again. It's also, we've seen this with regard to all the markets that have been affected by this war. When there are short-term shocks, as there have been with energy, oil and natural gas, for instance, and also with agricultural exports at the beginning of the war, prices go up, which they have done in the last week. Wheat prices are up about more than 10% in the last few days, even though they've moderated a little bit. But world markets stabilize because supplies come from elsewhere. There's a lot of agricultural products elsewhere in the system, but it's not configured to go to Africa and the Middle East, where a lot of the Russian and Ukrainian exports go. So probably if this sticks, the most pain is going to be felt in Africa, where Ukraine is saying bread prices are going to skyrocket just because they're going to get less grain. So, unfortunate victims of this war, hundreds and thousands of miles away.
Yeah, a lot of ripple effects there. I know you'll continue to track that for us. Rick Newman, thanks so much.
Bye, guys.
Potential home buyers getting a little relief on rates this week. The 30-year fixed dropping almost 0.2%. But lack of inventory, it's still a massive concern. Sales of pre-owned homes, that fell nearly 19% in June from a year ago, as higher rates keep current homeowners where they are. For analysis, we want to bring in Orfi Divungi, Zillow, a senior economist. Orfi, it's good to see you here. So just take a step back for us and give us your assessment of the housing market right now, the dynamics that are currently at play. We have the 30-year fixed rate still not that far from 7%. The Fed has remained, it says that it will stay aggressive in its fight against inflation. And there isn't a lot of supply out there on the market. So what does that mean for housing come the fall and winter?
No, totally. We had to some extent, sales are expected to slow. They peak in June and July and expected to slow for the remainder of the year because people tend to move in the spring. But this spring, we didn't have enough homes on the market, and shoppers can't buy what's not on the shelf. And that's because existing homeowners don't want to trade their low mortgage rate for today's higher rates. Our Zillow research shows that 90% of homeowners have a mortgage rate below 6%. And so it makes sense that new listings are down 28% compared to last year, and that total inventory is still half of what it was before the pandemic.
And Orphy, the Fed is expected to hike rates next week. How likely is it after that rate hike that we could see mortgage rates top 7%? And how much worse would that be for those existing home sales?
Look, the good news on the inflation front is that, inflation has come down substantially since the 9% peak roughly a year ago. And so that is going to put, ease pressure on mortgage rates and bring them a little bit lower. But at the same time, right, the fact that recession risk is receding means that, demand for safe assets isn't soaring. And so that, is going to put a floor on how low mortgage rates can get going forward. So I don't expect mortgage rates to increase as a result of the Fed raising rates. I just think that, the current economic environment and conditions basically means that mortgage rates was just not return to the low level that we saw during the pandemic peak.
So Orphy, I guess I'm going to press you a little bit here. How low then do you think rates are going to go? Are we talking a drop back to about that 6% level?
No, I think, it's really going to depend on inflation going forward, right? We're seeing data coming in that, retail sales came in lower than expected, but core retail sales were pretty hot. So is inflation going to continue to tick down? Can the Fed get core inflation under control and back towards the 2% target? I think that's really going to be critical for where mortgage rates end up going forward.
And selfishly for myself, Orphy, what does that mean for the first-time home buyer? We saw that group have the lowest share of June existing home sales in history.
Totally. I mean, for buyers, it just means that, there's still stiff competition in the most affordable markets and for the most affordable homes. We're seeing units flying off the shelves, right, in the Midwest, in areas that are still very, very affordable relative to the rest of the country. And at Zillow, we're trying to make the process really easy for buyers. One of the tools we have is our Zillow total monthly cost calculator, where a buyer can actually just put in what it is that they can afford or what they want to pay on a monthly basis. And we basically show them all of the inventory that will fit within their budget. I tell buyers in this environment, two professionals you need to reach out to. You need to have a mortgage professional on your side who's going to help you improve your credit, but also figure out what it is that you can afford. And you need to work with an agent because an agent's going to help kind of figure out what are the units out there that will fit within your budget. So that's my advice for buyers today. You don't look at the mortgage rate necessarily. Of course, it's important, but you don't necessarily think about whether or not mortgage rates are going to come down because, it's impossible to time the mortgage rate drop or to figure out where mortgage rates are headed. Now, there's also good news for buyers out there is that despite the lack of inventory, the lack of existing homes coming on the market, builders are kind of picking up some of the slack. We're seeing builder sentiment increase since January. We're seeing housing starts increase again. And builders still had a lot of inventory, a lot of units under construction that are now making their way on the market. So, while existing home sales have fallen, you're seeing kind of this buildup of inventory coming from the new construction site. And that's very helpful for buyers and renters in the long run. Also, builders have offered all kinds of incentives. They're trying to make the math work for buyers. They're offering 2-to-1 rate buy downs. They're offering to pay some of the closing costs. And again, that's good news for buyers in today's challenging environment.
Orphy, do you think home builders are still going to be offering those types of incentives given the fact that they are at such an advantage at this point in the housing cycle?
Yeah, I think the incentives are going to stay because ultimately the math has to add up. You have the largest generation, millennials, going into this housing market wanting to buy a home. And ultimately, if the math doesn't add up, they sit on the sideline and wait. And so builders have an advantage right now where they can build. They know what their costs are going to be. They know how much they can afford to give to buyers. And, for example, a 2-to-1 rate buy down right now is a very lucrative feature right now that's helping drive traffic to new construction, because builders are basically getting buyers where they would have been, a year ago in terms of mortgage rates and making it work for buyers. Buyers can save thousands over the first few years of home ownership by taking advantage of that.
And Orphe, we always hear cash is king when it comes to real estate. Are you seeing a lot of cash deals right now? And does that come with some negotiating power there as well?
Yeah, I think, I think I saw a stat saying something like 28% of home sales are cash, and cash is definitely on the rise because basically buyers that are not necessarily sensitive to interest rates are going to be more active in an environment where mortgage rates are so high, right? So yes, cash is definitely making somewhat of a comeback. It's high in terms of as a share of total sales in today's environment. But I think for first-time home buyers, at least, we at Zillow are focused on making home a reality for more people, and that means making the process less complex. Of offering tools to buyers, to potential home buyers. I mentioned the monthly cost calculator for home buyers. But we also have things like for renters, options for renters. So, for example, you probably heard about the White House talking about junk fees. A renter today has having to submit multiple applications just to get one unit, and those applications come with fees, and so they're paying multiple fees in order to get just one unit. And those fees have historically disproportionately harmed low-income families and minorities. And so at Zillow, we want to make those fees explicit, and we want to make sure buyers know what those fees are. But at the same time, we now have unveiled a new tool where basically buyers can just submit one application fee and apply to as many units as they want in order to save them on those costs.
Some welcome news there for potential buyers, because it certainly is a very, very tough market out there for them. Orphe Divounguy of Zillow, thanks so much for joining us.
It's a pleasure. Thank you.
Well, coming up, the Federal Reserve has launched a new payment system that could help clear your paycheck faster. We're going to discuss more on Fed Now next. The Federal Reserve finally launching its instant payment service, FedNow. Jennifer Schomburger is here to explain how it all works. Hi, Jen.
Hey, Shauna, it's official. The Fed finally launching its long-awaited instant payment service dubbed FedNow, which will allow consumers and businesses to send and receive payments in seconds. The system will allow you to pay for groceries instantaneously, businesses to pay suppliers, and people to pay each other. It will be available 24/7, 365 with full access to funds immediately. Here's how it will work. FedNow isn't offered directly to individuals and businesses through an app like Venmo. Instead, it serves as the basis for instant payments by linking banks. Transactions occur between bank accounts, enable funds to be transferred from a sender's bank account to a receiver's bank account immediately. FedNow is different from apps like Venmo, which require holding balances in the app rather than sending and receiving money directly to or from your bank account. And Venmo isn't instantaneous. It doesn't do real-time settlement. There's a lot of gymnastics behind the scenes needed to settle the payment. When FedNow is fully available and widely used, individuals will be able to instantly receive their paychecks and use them the same day. It could also help workers who aren't on a regular payroll, like gig workers, an Uber driver, for instance, get access to their wages faster. Now, people would use the service through their bank's apps or websites. It's very much in its early innings right now. Only 35 banks and credit unions, including JP Morgan and Wells Fargo, have signed up for the service. The Fed hopes to get more on board soon. Back to you.
So, Jen, if you're interested in using this payment platform, how can you check to see if your bank is partnered with this?
Hey there, it's great to see you at the anchor desk.
Thank you.
So you would really need to contact your bank individually. You could also check the Fed's website. They have a list of the banks that have signed on. There are some regional banks that have actually signed on. The two major biggest national banks I mentioned, JP Morgan and Wells Fargo, are the go-tos for the major banks if folks bank with some of those major banks. But again, I would ask your bank directly, or I would check the Federal Reserve's website.
All right, Jennifer Schomburger with the latest there about FedNow. Thanks.
Thanks.
Inflation is easing, but there are signs of slowing momentum in spending growth from June's retail sales. The consumer picture remains muddy for the average retailer. Here to take a deeper dive into the health of the consumer and looking beyond into the social marketplace, we have Poshmark CEO Manish Chandra. Manish, thanks so much for joining us today. I mean, Poshmark plays a big role in the secondhand fashion market. So how do certain economic conditions like high inflation play a role in your business? Are you seeing similar types of trends?
Well, we've seen definitely a slowdown in spend, both because of inflation and as consumers have sort of shifted post-COVID spending into travel and other things. However, I can say that towards end of June and beginning of July, we are seeing some acceleration, which is a positive sign. So keeping our fingers crossed as we head into the all-important back-to-school season.
Manish, what are consumers spending on, those that are still spending on the platform?
They are spending on very fast-moving trends. So one of the things that you see, especially with the younger consumer, which is a big portion of our constituency, is how fast they're adapting to different trends. I mean, this week is all about Barbiecore, and then you've got the Y2K trends. So for example, in June, our year-over-year sales of Coach bags were up 5x.
Wow.
And then Quiet Luxury, Stealth Wealth, Lorna Piana is up almost 100% YOY. So some of these brands are starting to see a renaissance driven by these trends.
And I noticed a stat that you have user engagement in the mid 20-minute range. That is pretty significant. How do you continue to keep users engaged on your app and website?
Well, for us, it's all about creating a very social experience, which gives both users a comfort to shop from each other, but also discover new styles. So in April, we introduced live streaming on our platform, and that's scaling very fast. While we've had problems in America in getting live streaming to adopt, we are not seeing anything. Last month, we had over 100,000 shows happening on the platform, and people are buying, selling, bidding, auctioning on that platform. So ultimately, engagement is all about people finding something fun to do, but also shop.
Manish, what has it been like just as a business leader navigating this very uncertain environment? Because on the one hand, coming out of COVID, consumers were still spending, they had the savings to do it. And now, like you were saying, we've seen this shift towards experiences. So what does that mean for Poshmark here in the longer term?
Well, for us, we are not just about spending, but also helping the consumer through this very stressful time, because people can not only shop at a discount, but they can also make money. So it's really great for the planet and great for the pocket. So what we have seen is definitely a little bit of a slowdown during 22, getting into 23, but with new trends like live shopping, faster trends, and then people just getting out and about, we're starting to see the business pick up. The other thing is because we don't hold any inventory, so it allows people to really merchandise to whatever is happening right now. And that fast moving velocity that we've seen coming out of COVID is in a way very, very long-term a growth accelerator for Poshmark.
Speaking of that fast velocity AI, that's something you guys are leveraging here. You have a new feature called Posh Lens. So basically you can upload a photo of something that you like and you will match so that consumers can more easily find it. Tell me a little bit about that, and are you seeing people engage with that
It's
feature?
very exciting. We've just been beta testing it for a few weeks. We are going live with that feature. Awesome. It's actually developed in partnership with Naver, which is the South Korean company that acquired us back in January. And so it's using some of the ML from them and some of the work we've done in terms of modeling. The interesting problem we had is we have inventory, but it's very distinct because we have like 100 million plus distinct SKUs. So building the model for that took some time, but it's really powerful. I mean, if I took a picture of your outfit right now, we'll probably find 100 jackets that are there at all different price points and brands. So it's very exciting from that perspective. It's early, but we are seeing a lot of excitement in the community around the feature.
And one of the other trends that we have seen within the secondhand selling market, ThredUp has reached some strategic partnerships with some of the larger retailers who are trying to get exposure to what you have at Poshmark. Is that something that you're thinking about? And I guess what kind of leverage, what kind of advantage could that maybe get you?
Yeah, I think for us, the big thing that brands find in the partnership, and some are partnered directly and some indirectly, is our community. We have a very vibrant community. We have over 100 million users on the platform. Just to give you a sense, over the last decade, our community has recycled over 200 billion items. So they get access to a pretty massive user base. And then it's a very engaged community. It's a very vocal community. So it's very powerful from that perspective. The other thing which is interesting about Poshmark is the scale and breadth of inventory. So, it's not very niche. We have luxury products, we have everyday products, we have products at all price points. So it really appeals from a very broad perspective.
And part of that community are influencers. I notice influencers on the Poshmark app all the time. Do you reach out to those influencers? Do they come to you? And how do you foresee maybe leveraging some of those influencers moving forward?
Influencers and creators are pretty much driving our consumption today. It's a little bit of both. We have people who open their closets on their own. There are people that we work with and do some charitable work. A lot of it is around what we see the consumer trends, which is this focus on micro community. I'm a dad, I'm a professional, I'm a baseball player, I'm like sort of going to pickleball or whatever my passions are. And each of those communities have different fashion needs, different clothing needs, and creators or influencers help sort of drive that growth for us and for that community.
Manish, when it comes to looking out here in terms of future growth for your business, for your industry, I think a lot of people out there are kind of questioning how much bigger this demographic could be in terms of your target, because I would guess it probably skews younger, right? Because it's the younger generations that are a little bit more conscious, or have been, I should say, about the resale market, and also not wanting so much waste out there. How do you capture that older demographic?
So we've been working at it. I think you see a lot more adoption of that. I think there's two things. One is selection. So I think the selection has just grown dramatically over the last several years. But the other thing is the stigma. I don't think today, if you go around and say, hey, I bought this on Poshmark, people will say, oh, no, they'll say, wow, tell me more. So that is the other big piece. But the progression of the closet from sort of a boomer who has maybe 10% of the closet at secondhand to Gen Z who's 17 to 18% is very encouraging. So I think the growth of the closet that comes from resale is going to expand, driven by both economic factors and just focus on climate change, sustainability. And the third thing is it's just good for the wallet as well in terms of making money and selling money. Which, talking to someone, She wore a bridesmaid dress, sold it the next day, and pretty much recovered what she spent on it. And if you think of a typical wedding season, when you have 8 or 9 bridesmaid dresses to buy, it's a very powerful tool to help you.
I've done that many times myself on your site, and it's effective. And you're right, you end up saving a heck of a lot of money in the long term.
Personally, I'm going to buy myself a Coach bag. My birthday's coming up. I'm excited. But Manish Chandra, Poshmark CEO, thank you so much for joining us today. Good luck with everything.
Thank you. Thanks for having me.
Coming up, we are sprinting to that closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers of the day. We see the Dow in positive territory. If it closes higher, it'll be the 9th straight day of gains. Stay tuned.
That's the closing bell on Wall Street. This market check sponsored by Tasty Trade. We're closing mixed, the exact way that we started the hour. The Dow holding on to gains off its highs of the day, though, up just about 162 points. You're looking at the S&P and the Nasdaq under pressure. The Nasdaq falling just over 2%. Communication services, technology, the worst performing sectors in today's trading action, along with consumer discretionary. All right, let's talk about some of the individual names. First up, we got to take a look at Johnson & Johnson, closing the day in the green, up just about 6%. The company reporting earnings here that beat the street's expectations. They also raised their guidance. Johnson & Johnson saying that it now expects adjusted earnings for the full 2023 fiscal year, $10.75 per share. That was up from its previous estimate of $10.65 a share. Certainly something, Allie, the street was very excited about. When you talk about a beat on both the top and bottom line, raising the forecast, Cantor was out with a note saying that there's a lot of strength in their business segments that remains, and they believe it's underappreciated when it comes to the price.
Yeah, polar opposite of what we saw with Netflix, Tesla, American Airlines. They disappointed on guidance. J&J, they boosted guidance, and that is being rewarded on Wall Street right now. We're also seeing some increased demand for surgeries, especially among those older adults that pushed that off during COVID. But overall, Johnson & Johnson's really looked at it as a bellwether in the healthcare sector. And I think healthcare is having a moment right now. I mean, we're talking about pickleball at one point, leading to more procedures done as more people are getting involved in pickleball. We had the first over-the-counter FDA approval for birth control drug. There's just a lot happening right now, and it seems like healthcare is just very strong, and Johnson & Johnson's result certainly proves that.
Yeah, certainly. The stock is still down year to date, but now off just about 4%. Not everyone on the street was at least as encouraged, or some, maybe the better way to put it, still have some questions just about what the business is going to look like here in the near term. JP Morgan's reaction, they have a neutral rating on the stock. They're still worried about that talc overhang. They're hoping to get a little bit more clarity regarding that, the impact here throughout the current quarter, the third quarter. But again, taking a look at the street's reaction, at least for now, we talked about the fact that companies are under pressure to beat and raise their guidance. And at least in the case of Johnson & Johnson, it seems to have satisfied investors for now.
Yeah, we'll see what the back half of the year holds for that, especially with those lawsuits overhanging. Moving on to Tesla, shares closing way down there, more than 9% following second quarter results. There were a mixed bag for investors, and the earnings call wasn't much better. Among the things investors were disappointed to hear from the EV maker were a slowdown in production in the third quarter due to factory upgrades and the lack of specifics given about the start of Cybertruck production. It's crazy to me that the Cybertruck is what investors care about, because personally, I just think this is a bit of a sideshow for Netflix. I think the larger story here is the margin disappointment, also the pricing war that we have going on, Netflix guiding that they'll probably have to continue to cut prices as we see more EVs come to market. And that's not just something that's happening in the US, it's also happening overseas in China.
Yeah, it's happening overseas in China. This is really a global price war when it comes to EVs. These companies like Tesla trying to increase adoption. Tesla, there were some questions just about the demand picture, how significantly that was deteriorating given the macro environment. So the fact that Elon Musk left the door open to further price cuts, that's one of the big reasons why we're seeing such a massive drop in the stock today. And like you said, Ali, this has been pressuring margins now. This is the second quarter that this has happened. So certainly something that investors, analysts are keeping a very close eye on. When it comes to what's going to be really move the needle here for Tesla going forward, a lot of the excitement in the stock was surrounding its a relation here with AI and how much of this is really an AI play versus an EV play, and the demand, lots of questions about that, and whether or not the massive run up that we've seen since the start of the year of a gain of over 113%, whether or not that's justified. And at least for today, following these results, analysts are still a bit cautious about Tesla's current valuation, saying that it could be a bumpy couple of months because of some of these concerns.
Yeah, it's an overheated stock, clearly. I mean, Elon Musk, he's one of those CEOs that just gets a rise out of most people. I mean, this quote, he said, "The Cybertruck demand is so far off the hook, you can't even see the hook." That is such an Elon Musk quote right there. We're going to be diving deeper into the Cybertruck story a little later on in the show with our auto reporter, Prasi Romanian, because there's a lot to talk about when we think about Elon Musk and the future of this Cybertruck. I mean, look at that.
Talk about your Elon Musk impression. That was pretty good.
Thank you. I've been working on it, practicing in the mirror.
You got to debut it, and this is the perfect time. All right, let's also talk about Netflix, the stock that I know you are very closely watching here. Closing the day off just about 8.5%. The streamer fell short of expectations when it comes to its forecast. That, of course, was a big reason why we saw shares under pressure. There was also a lot of talk about the password crackdown, what that would do to subscriber numbers. On that side of things for Netflix, that was a very impressive report here. It was nearly triple what the street was expecting in terms of new additions. Whether or not that momentum can continue, I think that's also a question.
Yeah, that's a big question. And if you think about where we were last year, Netflix lost 1 million subscribers. So now we're seeing 6 million added, which is definitely a positive for Netflix heading into the back half of the year. On the earnings call, they did stress that those certain revenue initiatives, like the crackdown on password sharing, like the ad-supported tier, that's going to take time to see the full impact, and it's going to play out in a few quarters to come. I read a note from Wells Fargo analyst Steve Keyhall earlier this morning, and he said patience is a virtue, especially when it comes to those long-term Netflix investors. So you have to be patient and you have to wait things out in order to really see the benefits of some of these initiatives. But we also saw profitability metrics like operating margins, free cash flow come in above those estimates. So compared to a lot of media out there that's very a lot of turmoil right now in the industry, they're doing pretty well.
And also, we haven't even brought up the issue of the Hollywood strike right now on the writer side, on the actor side. Many analysts out there saying that Netflix is best positioned among its peers, given the fact that it is a very deep shelf when it comes to content, also its international exposure. But you got to ask the question, I know it's something that you've been looking into too, how long this strike drags on. At what point are we going to see a material impact on Netflix?
Yeah, Netflix specifically talked about these strikes. It was the first question on the earnings calls. Co-CEO Ted Sarandos, he said, we want a deal. We want to get this done. No one expected this to happen and to last for as long as it's happened. And I think the longer it goes on, the more pressure it's going to put on Netflix and all of these media companies to make a deal.
Yeah, certainly. Netflix, one of the worst performers in the S&P today. All right, let's take a look at Amazon. Amazon out with a big announcement today on its Palm payment technology. Yahoo Finance's Brooke DePalma has the story for us. Brooke, we've talked about this technology in the past, but now it's actually getting deployed.
Right, absolutely. We talked about this technology earlier this year with Panera Bread's CEO, they rolled this out at 2 of its locations. But the top story today, Amazon rolling this out at all 500 plus Whole Foods locations. So essentially, how can shoppers sign up? Well, they can go on their Amazon account, use their credit or debit card, put in their mobile number, and essentially go to Whole Foods, scan their palm, and they're enrolled. Pretty easy there. But in addition to that, of course, other locations that offer this technology includes a baseball field used by Colorado Rockies MLB team. They use this technology to get a gauge on ages for their customers and their fans. And the Whole Foods Market Chief Technology Officer really saying here that Amazon One is a complete convenience play. And since they enrolled this technology, which is now available in about 200 locations currently, customers essentially have loved the convenience factor of this. Of course, Amazon stock down today, but this news rolling out by the end of this year to all 500 locations at Whole Foods.
And Brooke, I gotta say, whenever I go to Whole Foods, I'm always tempted. I'm not enrolled in this currently,
Right,
but I'm always tempted to put the hands. Like, this is kind of cool. Yeah, so certainly something I'm gonna be looking into. But also other things you're watching, earnings season underway. We have some big food names reporting. Who's up first?
Absolutely. Well, Domino's kicks off next week earnings block of fast food and fast casual companies, followed by Chipotle out on Wednesday, McDonald's out before the bell on Thursday, and Sweetgreen after the bell. Now, taking a closer look at what exactly analysts are expecting in terms of these big players, Domino's expects low same-store sales growth, but ultimately, this is just a low hurdle for Domino's to get over. Many on the street waiting to hear more about the Uber Eats partnership that many think will benefit same-store sales growth later on this year, or rather in 2024 and beyond. Chipotle, in addition to that, of course, as we noted before, they're set to report on Wednesday after the bell. Same-store sales up there are expected to be nearly up 8%. They're expected to regain market share as they kept prices below peers in 2023, so ultimately benefiting from that value advantage that they now have over their competitors. But food inflation continues to weigh in the company. Beef right now makes up about 20% of their food basket. Avocado makes up about 9%. Both are seeing higher prices. But in the call, we're also hoping to hear more color on the expansion into the Middle East. And moving right along, McDonald's continues to gain foot traffic because of that lower income audience, in addition to a tighter consumer wallet. We expect same-store sales to be up more than 9% there, led by international same-store sales growth. Of course, menu pricing and market share gain continues to be played for them. And we're just waiting to hear more on that Grimace shake and how that blew absolute expectations of how it performed in the month of June. Also, that's expected to carry on into early July. And we're set to close out the week with Sweetgreen. They're set to report Thursday after the bell. Of course, this past quarter, they launched that chicken and Chipotle bowl. In addition to that, they did take an additional 1% pricing at the beginning of the quarter. They also launched their loyalty program, but tomato and chicken costs, they're lowering now. So that's something Wall Street is looking out for.
The Grimace milkshake. Have you tried it yet?
I have not. And I think it's gone already.
I haven't.
It's gone already? I know. It looks so good. It was all
plain
over
vanilla.
TikTok.
Plain vanilla for my
You
milkshake.
are?
Yeah. I know.
They're also coming out with a peanut butter McFlurry, rumor has it. So
I saw your tweet about that. That looked so good. And that's right up my alley. All right, Brooke, you're also keeping an eye across the consumer staple sector. We heard Pepsi, they reported last week, got off to a pretty strong start. Coca-Cola's on deck next week, right?
Yeah, Coca-Cola, Keurig, Dr. Pepper, as well as Mondelez, all on deck for next week. And what we're really looking to gain further insight to is really pricing power that these companies have over consumers. All these companies continue to increase prices, and now they're seeing volumes. For example, PepsiCo last week saw volumes decline for the past, I believe, 3 quarters. And so really what we're seeing here is ultimately how they continue to raise prices and how exactly volumes continue to remain to slow down or rather lower in these upcoming quarters. Of course, Coca-Cola, their price mix up nearly 7.5%. Keurig Dr. Pepper prices up nearly 7% year over year, but volumes of Keurig Dr. Pepper expected to drop nearly 3%. And so really, when will the consumer stop putting up with these higher prices, and when can we expect prices to drop year over year, if at all?
All right, Brooke, you're going to be very busy next week.
Yeah,
we'll be
absolutely.
watching it all. Thank you so much for joining us. Coming up, we're looking at the implications of the Hollywood strike and which companies are best and worst positioned. That's next.
So you should know that nobody here, nobody within the AMPTP, and I'm sure nobody at SAG or nobody at the WGA took any of this lightly. But we've got a lot of work to do. There are a handful of complicated issues. We're super committed to getting to an agreement as soon as possible, one that's equitable, and one that enables the industry and everybody in it to move forward into the future.
That was Netflix co-CEO Ted Sarandos highlighting the streaming giant's commitment to reaching an agreement on new labor deals. Shares of the company under pressure, closing down more than 8% today after guidance for next quarter came in below analyst estimates. But according to our next guest, Netflix is one of the least at-risk companies in the wake of the strikes. Joining us now is Neil Begley, Moody's Investors Service Senior Vice President. And Neil, we did see Netflix boost its free cash flow guidance, saying it now expects $5 billion instead of the prior $3.5 billion, citing the strike specifically. You also credited Netflix's wide range of content, their international exposure. But at what point does this strike start to hurt Netflix from a churn perspective and even ad revenue perspective?
Well, Netflix is no different from any of the other players in the streaming business or frankly in the linear business. So for all of them, they've stockpiled content, and when that content runs out, that's when it starts to hurt. They'll smooth out their distribution of the new content for as long as possible. They've stockpiled a lot of new original shows, and they've got lots of library content. But once subscribers start to notice that the originals are not to be found, they'll start acting with their feet.
Neil, you've been covering this industry for quite some time. From your perspective, the demands that the actors and the writers are making versus what we're hearing from the studios, do you think it's likely that this is going to be a lengthy holdout?
I think so. I think it's basically a perfect storm, because you've got a period of time when you've got the linear business in decline and putting pressure on a lot of the traditional media companies. At the same time, they're launching streaming platforms that have experienced nothing but losses now for the most part for 2, 3, 4 years. A lot of them are starting to see the light with regard to potentially break even. Some have passed the point of the worst of it, where they're had peak losses, and some are just at that point right now. So that means these companies are under a lot of stress. And at the same time, on the labor side, these people who are essentially fighting for their lives, essentially their livelihoods, have experienced a time of transition as well. And a lot of their way they get paid is based upon the old guard, where a lot of product is then sold to third parties. And when it's sold to third parties, you can measure the value. When you're putting on your own platform, it's harder to measure that value and get paid.
Mm-hmm. And you said that the DGA contract, which was ratified and signed, coupled with potential new WGA and SAG contracts, that'll cost media firms $450 million to $600 million more per year. How do you see those extra costs impacting these companies and their credit ratings?
So that's on a static assessment of what they produce. If they decide to produce less, obviously they'll spend less. They also will look to cut costs in other ways, whether they essentially reduce post-production, whether they reduce special effects, they have fewer stars in their programming, or frankly, they try to pass along those costs to whoever they sell that content to or to consumers.
Neil, who's hit the hardest? So Netflix is best positioned, although obviously not in a great position given everything that's going on. Who's going to feel it fastest, and how big of a hit are they going to take?
Well, everybody's going to feel that this is a long strike. Mm-hmm. However, in the interim, there's actually more money to be made by many of the media companies because they're spending less on production for a while, just like we saw initially in COVID. And frankly, with Netflix as well, they generated free cash flow before anyone thought they would because they weren't producing any new content. However, once that content evaporates, the cinemas, for example, they rely on new content only. They have to put people in seats. They have to sell popcorn. And when the new content evaporates and there's a lull in the new original films coming out, they're going to feel it the worst. Not only because of that, but because their models are not very well diversified, and also because their balance sheets are weak.
When would we see that lull?
I would think that would be sometime in 2024. I believe most of the films that have been in the can for a while, with the plan that this strike could last throughout the rest of the year, are fine.
Yeah, because I was going to ask about that, because movies tend to have a way longer lead time than, say, some of the cable shows that are on some of those more diversified linear networks, like Comcast, for example, right?
Yep. Yeah. So Comcast is very diversified. So if you've got a very diversified business, they make a lot of money in broadband, for example, that generates essentially 70% of their revenues. They're not as reliant upon their media businesses as many other companies are.
Wow, very interesting. Well, certainly I think everyone's hoping that these double strikes end sooner rather than later. Moody's and Niels Begley, thank you so much for joining us.
Thanks very much.
Well, Americans are worried about their finances. 20% say that they believe they will not be able to retire. And the main reason for that, it's because they don't think they can afford to. This is according to new Axios Ipsos poll. Let's talk a little bit more about it. Yahoo Finance's Carrie Hannon has been digging into this survey. And Carrie, what did you find?
There is a lot of angst out there. I tell you, there is just this real fear that people simply say, hey, I don't have enough to even save right now. And, nearly half of Americans simply said in that survey that they're unable to save. So that's pretty daunting. The interesting thing also, though, is that it's kind of, they also say they're not going to be able to retire when they expect to retire, which means that, they're concerned they're going to have to work longer, which I talk about all the time, and I think that's a reality. But in fact, sometimes you are going to get pushed out of the workplace for a health reason or what have you. And so people are simply not prepared. And so that's a little daunting. But the curious thing is like mum's the word. This survey found that people aren't even talking about retirement saving with their friends. 1 in 4 4 said they never discussed it with their friends. And about, I think they said, a huge percentage, maybe it's something like 6 in 10, have never even spoken to a financial advisor. So it's as if they're not doing anything. They're kind of frozen with this inertia. And this actually backs up other reporting that we've been following with Transamerica that came out with a survey showing that, in fact, when you ask people about retirement savings, how much they're going to need, they're actually throwing a dart. They admit that they are more, a majority of people are saying they just are simply guessing how much they need. This is not a good place to be, and they're saying again in that study, in the Transamerica one, that a huge percentage, a quarter of boomers and almost half of millennials and Gen X say, they're just having trouble making ends meet. So I find this all a bit concerning, but the worst piece of all of that is that 1 in 4 said, you know what, I prefer not even to think about it. Like, let's put our head in the sand because I'll think about it when I get closer. It's kind of that Scarlett O'Hara thing. So those are things that, the angst is out there. It's not a hopeless situation, but this survey from Axios really did indicate what people are feeling out there, which is fear.
Yeah, I guess ignorance is bliss sometimes, Kerry, right? But another issue here is that a key part of retirement savings for many Americans is that work-sponsored 401k plan, but not all consumers have one. So what can be done to help?
I know those of us who have a plan are a little spoiled. The fact of the matter is almost 50% of Americans do not work for an employer that offers a retirement plan, an employer-sponsored plan. And what happens here is that if you don't have an employer plan, you simply don't save. I mean, people have a really hard time getting started saving for retirement if they don't have an employer plan that automatically takes money out of their paychecks and pushes them on this path. So that's been a real problem. There's been this real savings gap because of this issue. But what is happening that about 19 states so far have passed legislation that these are called like state automatic IRAs, where employers are mandated to enroll their employees in a state-sponsored plan that gets them kickstarted with a retirement savings plan. Maybe 3 to 5% of their salary is automatically deducted through payroll deductions, and they can get started. This is relatively new. These are just rolling out across the country, and that's super positive. It's not a huge amount of money, but it does get people started. That's important, and people can opt out. You don't have to do these plans, but the thing is, once people are auto-enrolled, they often don't opt out. So this is positive. The last thing is the National Bureau of Economic Research came out with a study the other week that showed that in states where they have these states plans, more employers are actually starting to offer 401ks to their employees. They're not sure exactly the cause and effect, but a new law that just started this year for companies of 50 or fewer employees, they now get a tax credit that covers 100% of those administrative costs for running a plan. So there are more incentives to get small businesses to kick off their own plans, but maybe having the state starting it is giving them a little bit of an incentive to let's see what we can do for our employees so we can retain and attract more workers.
Just getting started, and those benefits are so important, and workers need to take advantage of them in order to be better positioned for retirement. Kerry Hannon, always great to hear from you. Thanks.
Thanks.
Let's do a check of the market sponsored by Tasty Trade. The Nasdaq, the biggest decliner of the day, closing off just about 2%. It's the biggest one-day drop that we've seen for that major average in just over 4 months. Disappointing results from Netflix and Tesla are to blame for the halt that we did see for the Nasdaq, at least for today. The S&P also closing to the downside, off just about 0.7%. The Dow closing up 163 points. Johnson & Johnson, a top performer there. Coming up, actor and author Ben McKenzie joining the show with his new book that's all about the wild world of crypto. We've got that for you next.
The crypto community is optimistic after the Securities and Exchange Commission announced it will review several applications for spot Bitcoin ETFs. These funds would give investors indirect exposure to Bitcoin. It's unclear whether the applications are ultimately approved. Those in the crypto industry believe approvals would be a boon, but our next guest has been an outspoken critic of cryptocurrency. Joining us now is actor Ben McKenzie. You may have also seen him in roles on TV shows like The OC and Gotham, and now he's the author of the new book, Easy Money. Ben, thanks so much for joining us here. You are a crypto bear, to put it lightly. You call crypto a scam. You say it operates much like a Ponzi scheme, but there are a lot of crypto bulls out there that say blockchain is here to stay. So why do you have such a critical take?
Sure. Facts mainly. Blockchain is over 30 years old. It's not a new technology. A blockchain is a distributed ledger, way of storing information. So I have nothing against a ledger. Really not mad at ledgers. It's the way they're used for, selling people unregulated and licensed investments, which I think really cryptocurrencies are. Because I have a degree in economics, I know. Well, most people really know that one of the things that money is supposed to do is you're supposed to be able to buy and sell stuff with it. You can't do that with crypto. It's really, and people aren't using it as money, of course. They're using it as a form of investment. So they're putting real money into it, hoping to make real money off of it through no work of their own. We obviously have securities laws in this country for a reason. The federal securities laws were created in the 1930s because in the 1920s, we did not have them. And the Roaring 20s was really, really fun until 1929 and the crash that led to the Great Depression. And the powers that be realized they really needed laws. Otherwise, people were going to lose their money. And our securities laws are predicated primarily on disclosure. Basically, when you're investing your money, you need to know who you're giving your money to and what the hell they're doing with that money. Well, crypto, almost sort of by design, doesn't have that. The pseudonymity of the blockchain obscures who owns what cryptocurrency or how much of it they own and who owns it. And so that allows for a lot of potential illegal activity, particularly wash trading, which is an enormous part of the cryptocurrency market. So regulators really need to figure out, in my opinion, sort of what's really going on here, how much of this is real and how much of this has been artificially inflated. And then perhaps we can figure out what the future for these quote unquote currencies is.
Yeah, Ben, we've heard Congress lawmakers talk about regulation, the need for regulation within the space for quite some time. We had SEC Chair Gary Gensler. He was on with Yahoo Finance earlier this week talking about the crackdown that he wants to see on crypto. I'm curious from your perspective, from a regulation standpoint, what do you think needs to be done? Obviously, there's a lot of areas that need to be addressed, and you're right to bring up some of the massive issues within the crypto system. But I guess what are the biggest issues that you think should be tackled first?
We have to enforce our securities laws rigorously. But as I point out in the book, I do a whole chapter on sort of how do we get here from a regulatory perspective. And so for the finance dorks out there, econ dorks out there, public policy dorks out there, this will be perhaps your favorite chapter. But it's really fascinating. We're the only country in the world that separates our securities regulation from our commodities regulation in the way that we do. We have two agencies, the CFTC and the SEC, competing over jurisdiction. And there's a gray area between how we classify securities and commodities. And Bitcoin became classified as a commodity because futures were being traded of Bitcoin. And under the CEA, the Commodity Exchange Act of 1936, because futures are being traded, you could classify Bitcoin as a commodity because it had not been classified as a security. And yet the 20,000 other cryptocurrencies that currently exist today sure look like securities to me. And to the eyes of many regulators and many people who know more about this stuff than me. And yet they hadn't really been classified in a way that I think the precedent hadn't been set that would apply to all of them. So we're doing these sort of one-off cases, and we can talk about Ripple if you want. But look, the application of the law is messy, and crypto has exploited this division in how we classify securities and commodities and sort of played the agencies off against one another, in my opinion. The crypto industry would really like the CFTC to regulate them. The CFTC is a smaller agency. It was about 1/4 of the budget. I think it's really important to kind of understand basic things about how we got here.
And I'm curious, Ben, to also get your perspective here as a fellow celebrity. We saw other celebrities really promote a pump and dump crypto scheme. They were fined by the SEC. What kind of warning does that flash when it comes to how celebrities partner with certain, what they promote on their social media, and how does that impact what you do and what the partnerships that you strike?
Well, I mean, the celebrities celebrities have always sold products ever since there have been celebrities. The difference is these are not, this isn't car insurance. This isn't soap. These are financial products. And you're supposed to be a licensed financial advisor. You're not supposed to give financial advice unless you are one. But that's effectively what these celebrities were doing. And the reason that they shouldn't have been doing it in that sense is that we really want, if you're making an investment, you really want people that know what they're talking about. But of course, celebrities are, quite effective in speaking to the general public. And so, and they're quite wealthy. And so it's very easy for, or many of them are quite wealthy, some of them much more than me. It's very easy for us to make this cognitive jump between, oh, well, it's a famous person who's very wealthy and they're encouraging me, saying I should buy this or that crypto or bet on this exchange, gamble through this exchange. It's very easy for us to go, oh, they must know what they're talking about because they're so famous. But it's not necessarily true. I don't know these people personally. I mean, I guess probably I've met a few of them in passing, but this is not a personal situation. It's just me saying, this is how it works. This is what I've investigated over 2 years, and stop doing it. And you'll notice all of a sudden the ads starring celebrities and cryptocurrency companies, they've pretty much disappeared from your television. Not nearly as many this year as there were last year.
And Ben, I want to switch gears to the double strike happening right now in Hollywood. You are actually part of all three guilds, the directors, the writers, and the actors unions. Why do you think the studios were able to sign a deal with the directors more easily than the writers and the actors? And are the wants here, are they similar across all three? What are the biggest differences?
I think there are some substantive differences, I mean, they're different professions, right? Some similarities, and they need to work together, but directors have different issues than writers, different issues than actors. I'm here in my capacity as an author, but in terms of my unions, I support them. I support my fellow writers. I support my fellow actors and performers, and we're just looking to get a square deal. It's really unfortunate, really sad that we're here at this place where it seems like we're so far apart from these studios that have made so much money. But, as soon as we strike a fair deal, trust me, I can't wait to get back to work. I won't have to talk about cryptocurrency anymore, which would be really nice.
Yeah, I'm sure you're one of many actors, writers that are looking to get back to work. Ben McKenzie, author of Easy Money, thank you so much for joining us.
Thanks.
Legendary boxer Oscar De La Hoya is back in the spotlight with a new upcoming documentary, The Golden Boy. That's out July 24th. He sat down with our very own Brian Sazi to reflect on the triumphs, the turmoils, and also the money moves that he has made throughout his career.
At 50 years old, I just thought, look, it's never too late to really tell my side of the story, the truth, basically. I guess what people don't really know is that at the age of 6 years old, I was conditioned to be a fighter. I was conditioned by my family. I was conditioned by my father, who was an ex-fighter himself. And just having that weight on my shoulder, of being labeled as the next big thing in boxing, and all that pressure from family and, oh my gosh, little Oscar's gonna take us out of this neighborhood and he's gonna buy us a home and this and that. So the pressure from that, and then winning the gold medal in 1992, the pressure from the world. And so basically I lived, it's almost like living a double life. I mean, yeah, I'm a great guy and I'm a nice guy and everything, but it's like when you retire from boxing and when you lose your identity, you lose yourself. And so I just wanted to show the world that side of me. That double identity life that I was living, and it's pretty interesting.
You came right out of the gate here.
Yeah.
I checked out the trailer. You're like, I was driven by a lie.
Yeah.
I mean, what's the lie?
The lie was when I won the gold medal in Barcelona in 1992, my mother had passed away a year prior to that. And media members, especially in the Olympics, had this story that it was my mother's dying wish for her son to win the gold medal. And so I just went with the story. I just went with it. Like, yeah, oh yeah, I'm doing it for my mom. I was doing it for her, obviously, but it wasn't her dying wish. And so all those years of living with that, the lie of just like telling people, yeah, I did it for my mother, I did it for my mother, it weighs on you, you know, because it was a lie. She didn't tell me to win the gold medal for her. I mean, I did win it for her, but she didn't tell me, you know? And just everything that goes with success, with money, everything that goes with fame. It was a rough life. It was a rough life.
Is there, is it fair to say that pressure drove you throughout your career?
I think, and this is where the documentary is very, very good and interesting. The pain that my mom endured on me, the physical abuse that I went through, I think that's what drove me to become the best athlete I can become, the best fighter I can become. All that pain, all that anger. I stepped inside the ring, and I'm glad I had that outlet as a fighter. Made me the champion I am inside the ring.
I have a couple business questions for you, but
sure.
Before I even get there, what's the next decade look like for you? I saw on TMZ you explore potential running for president, maybe a mayor for Las Vegas. Really, I mean, are these things in your cards? I mean, everybody knows who you are.
Everywhere I go, especially in California, it's, oh, you should run for this, and I'm okay.
You're okay.
I'm
so
okay.
No runs, nothing to
politics,
announce here on Yahoo.
No politics, nothing like that.
Okay.
So I run Golden Boy Promotions, one of the biggest boxing companies in the world, and continue building fighters, continue building champions. The pay-per-view game it's so interesting now that linear TV is, somewhat.
Look, we're seeing with the actors strike.
Right,
this
exactly.
is exploding.
Exactly. Here. So now you have all these platforms where you can basically build the next superstars of boxing and make a lot of money, which is amazing. And so. We've been able to manage over 100 fighters. We're promoting the biggest events in boxing, and so just continue because this is the sport that gave me everything, and I love boxing.
Well, how would you compare this generation of fighters compared to your generation?
My generation, I think they were tougher. They were. It's like when the going gets tough, the tough get going. It's like, they were a little tougher, mentally and physically.
I can only imagine now, some business questions. I can only imagine some of the things you got offered through the years.
Sure.
So, best business deal you ever made?
The best business deal I ever made. So I actually with my partner, we purchased the Barney's building, right? And it was the best move we ever did. Made a lot of money, but it was the worst decision we ever made as well because we sold it too soon.
You sold it? What made you sell it? I mean, that's just, wow.
Well, we saw that we were just making so much money. We said, okay, it's time to sell.
Yeah.
And it was the worst decision I ever made.
Who have you gotten advice from through the years, money-wise? I mean, is Warren Buffett giving you a phone call? I mean, have you talked to any folks like that?
Experience.
Yeah.
It's all been experience. And I don't know what it is or who's looking down at me. I surround myself with really good people, with really smart people. And I've been able to just make the right choices, the right business decisions, and just be very careful, Not rush into something that because it looks good, just do your due diligence, do your homework, basically.
I would say you're an entrepreneur now. I mean, what are some of the things that keep you up at night as you run a business and try to grow this business over the next 10, 20 years?
I try to invest in what I believe in what I know. And it's been working for me over the years. I've been able to acquire several publishing companies that are within the boxing world, and obviously now publishing is now digital, we're building something very special there around the sport of boxing, which is very exciting for me. But I just love building. I love building, the next big thing for our sport, and I think that boxing I mean, imagine fighters from the past fighting against fighters.
Are you getting back in the ring?
No, but AI style. I think I will.
Interesting.
I mean, it's very, very interesting. I mean, imagine Joe Louis going against Mike Tyson.
And I would bet on that or watch it. Where would you watch it?
Yeah, you would. So we're creating that platform now, and it's going to be very, very interesting. So watch out for that.
That is wild. Lastly,
It will be
speaking of a
wild.
match like that, community question, because a lot of folks knew that I was talking to you. Who would win a cage match, Elon Musk or Mark Zuckerberg? You have to be following it.
I'm following it, and if they are or they want to box inside a ring,
okay.
I mean, give me a call. I'll promote
You hear that, guys?
it.
Elon,
I will promote it.
You're hearing here from Oscar De La Hoya, please. I mean, do you have any?
But I like Zuckerberg because
jiu-jitsu is crazy.
Yeah, his jiu-jitsu is crazy. He looks like he has a better, I don't know, coordination. He has better coordination, but you can't count out the richer man.
I mean, we're not topping that answer. We're going to leave it there. Oscar De La Hoya, I mean, just good to see you.
Thank you, man.
Good luck on the documentary. It is Golden Boy, 2-part series on HBO. I encourage everyone to give it a watch. Thank you so much.
Thank you.
Appreciate it.
I'm siding with Oscar, too, on that. I'm with him. I think Zuckerberg will win in that fight. Well, our thanks to Oscar De La Hoya and, of course, Brian Sazi as well. Well, it's time to go around the horn and check in on some of the trending stories of the day. Josh Schaefer, Alexandra Canal, Press Subramanian, take it away.
Yeah, Shauna, we're taking a look at some of our favorite stories of the day over here, and I want to start with the strike and sort of the trend we're seeing in strikes. So, Ali, I know we've talked a lot about the Hollywood strike, writer strike, actor strike, but another thing we're seeing now is potential strikes that we might see across other industries, right? So it's been interesting to see there might be a strike coming for UPS. There might be a strike coming across in your industry with some of the autos. There's a funny quote in one of the articles calling it Strike Girl Summer or Hot Strike Summer or something, which I thought was Hot Strike Summer, pretty funny phrase for a not funny topic. But it's been interesting to see that sort of pick up and how maybe groups start to rally around this, right? And you see it beyond Hollywood. I feel like we've talked a lot about Hollywood and haven't necessarily broken down some of the other strikes that are happening as well.
And I think there's a strength in numbers mentality here. You become pretty emboldened once you see others going out there and fighting for certain rights. And I think that is on top of timing here. We're coming out of the pandemic where a lot of these on the company side as well have faced a heck of a lot of challenges. A lot of things were delayed because of the pandemic, particularly in Hollywood, right? These deals come around every 3 years. The last time we were having this conversation, it was 2020, where everyone across the board, actors, writers, directors, they just wanted to keep the lights on. But there were still these issues in the background. So now here we are 3 years later, and everyone's had enough. They said, okay, we kept the lights on, now what's the next step there? So I think timing, coupled with this very tight labor market that we're seeing, is really ground for breeding a lot of these strikes, but then it's difficult on the company side to try and make a deal. And at least with the Hollywood strikes that I'm looking at, a lot of these media companies, they are bleeding money and they they don't have the flexibility to make this grand deal for what these actors, writers want. So it's a very complicated environment right now.
But they're also pretty pressed because they need the content at some point too,
It's
right?
it's a push-pull.
They do need the money, so they're going to have to figure that part
It's
out.
a who's going to cave first situation.
Of course.
Yeah.
So I think it is a big year for labor, right? So the UAW on my side of the ledger here, they're going to threatening to go on strike if they can get a deal done this fall with the 3 major automakers. You have the UAW putting out a statement of support for the WGA and SAG because they're all kind of in together. And why? We're in the middle of earnings season. I'm sorry, companies are making a lot of money and labor saying, where's our share? Look at the data. Labor this is the lowest share of corporate profits they've ever had. That's how low it is. Coming out of the pandemic, they didn't want to step on any shoes. So it's sort of like, I can see why this is happening. Inflation kind of taming, but it was there. High interest rates. Blame Jay Powell. I don't know, but I mean, it's just a big summer for labor.
Plays a part of it, though. When you look at a lot of different consumer kind of surveys, right, it's starting to come down a little bit with the most recent inflation print and in the last couple months. But generally, people have sort of felt inflation is higher than it actually is, and it's impacting them maybe at an even further level than some metrics show. I think it's a time right now where people are very focused on those things and are saying, well, things are more expensive at the grocery store. It's impacting me. My job should match inflation. I just hear that all the time from people, from friends, right? Why isn't my raise matching inflation? Inflation was 9% last year. I didn't get a 9% raise. That's not necessarily how it works, but that's how people look at it, and that's what workers want.
Your rent's going up for all of us. And then again, we're in earnings season. We're seeing those Netflix had a good quarter, right? They made a lot of money, right? So where's my share, right? That's what Ben McKenzie and people are asking about, right? Yeah. Moving on, sticking with autos, let's move on to Tesla. Yesterday they had their earnings report out. News on the Cybertruck. Elon talking about how demand is very strong there. They gave an update on when they want to actually potentially see deliveries at the end of the year, potentially production. But back on demand, he was very bullish on it. Here's what he had to say.
Demand is so far off the hook you can't even see the hook. So that's really not an issue. I do want to emphasize that the Cybertruck has a lot of new technology in it, like a lot. It doesn't look like any other vehicle because it is not like any other vehicle. And the production ramp will move as fast as the slowest and least likely element of the entire supply chain and internal production.
Musk said there's about 10,000 parts and systems on that car that need to be kind of like, if any of them is a little bit slow or not lucky, as he said, the production slows down. So that's sort of a big deal for them as they ramp up a brand new product. And Adam Jonas this morning talking about how he thinks that Musk has assuaged investor concerns about the fact that he sort of allayed concern that, hey, we're on track. It's going to be this year. Don't be upset.
I just can't get over, we do a lot of the vibe checks, right, on what the earnings calls are like. I mean, that sounds like your buddy calling you up and telling you about cars and like get excited.
He talks in like a riddle.
Yeah, it was just like, sometimes I feel like after these calls, his lack of specificness.
It's very broad.
Like, that's what
it's
hurts
off the hook.
Tesla
you can't
sometimes,
even see the
right?
hook. It's a lot of technology, a lot. Like what does that mean?
What does it mean?
Yeah.
And what is the actual demand? And can you give me any sort of metric for an actual demand? At one point in that earnings call, he basically said that the analysts were trying to get too specific, and he said, let's just move on. I forget exactly what they were
talking
asking.
about gross margins. We're getting too specific on it. We can't gauge that. There's rates, there's this, there's that, there's the world market. We can't give an actual forecast on gross margins based on the world being so unknown, right? Which obviously a lot of companies will give gross margin kind of projections.
What did people care about on the call? Gross margins. Right?
Yeah.
Like from like what the stock did today, the stock fell almost 10% because when they wanted gross margin guidance, he just didn't give it. I don't understand at some point why you don't just give a little bit more specific answers when people are looking for specific answers.
You see the trend, it's trending lower. The question is is this the bottom? And there was no answer to that. Stock was up a lot. I'm not surprised with a 10% drop here.
No, it's true. And even if demand is high, I know one thing you're concerned about is will the supply be enough to keep up with the demand? Because that's something we've seen with Tesla. It's been an issue.
Yeah, never been a demand problem.
There we go. Well, Elon Musk, very influential figure. Another influential figure that I'm following, I'm always following her, Kim Kardashian, because her company Skims it got a pretty sweet valuation. They raised another $270 million in a new funding round, which values the company at $4 billion. Now, one question that's been floating around is whether or not Skims could go public and whether this could be an IPO that leads to more IPOs down the line. We've seen a significant drought in the IPO market, but if there's anyone that can bring the IPO back, I feel like it's got to be Kim Kardashian, right?
Allie, we're back. I think we're already back. We had a Korean barbecue chain go public.
You're right.
There's rumors that Liquid Death, which sells canned water, that's their main product, is canned water. They might go public at a north of $1 billion valuation. And then SetJet also headlines that they might go public. You've probably never even heard of it. That's a private jet company. They're trying to go public via SPAC. I feel like we had the Kava IPO.
Yep.
That opened it for me. And now we're just seeing companies that you sort of make you go, that company's going public? And I don't think Skims is in that category, though, I would say Skims seems like a much different growth story led by Kim Kardashian, obviously a very popular brand, but it already feels like we're getting a little bit into froth of IPO where it's like a Korean barbecue chain is going public.
The thing with, if you don't mind, the thing with Kim Kardashian is like, you think retail investor interest is high right now? Imagine if Kim Kardashian has her own company public. Imagine the amount of inflow of new investors wanting a piece of that. We see that with Elon, see that with GameStop. We see Elon advising small investors about this. I could see Kim Kardashian becoming the next mogul.
Oh, totally.
I'm sure he is.
Yeah, and I feel like she always wants to push the envelope with her businesses. And this would be the perfect opportunity to do that, especially considering, like you said, we are in a healthier environment with the IPO, and we've seen a lot of those companies like Kava, it did very well on its IPO.
Kim K on an earnings call.
Oh
Kim K leading an earnings call?
The number of likes she will say on that earnings call, like
I wonder
the
if they could
revenue
get
was
that.
like the vibes on the revenue.
No, we like Kim. We want you to come on the show.
Could they get that like live streamed? See, like that's when you could make it into a show, basically. Turn an earnings call into a broadcast production.
We do love you, Kim. We want you on the show.
Absolutely.
This is our, especially if you IPO. Especially if you IPO. But yes, this is someone that I feel like a lot of people follow. She's a big name in the business world. She's well connected, and I wouldn't be surprised if it happens. Just saying. Yeah. All right. Well, we have a lot more on the other side of this break. Stay tuned to Yahoo Finance.
Warner Brothers' Barbie has fans buzzing, but it's much more than just a movie to Mattel. The company is betting big on Hollywood, with several movies based on its toys already announced. Here are some of the top films in the works. Polly Pocket. Lena Dunham is planning to write and direct, while Lily Collins is set to star as the famous Micro Doll. Hot Wheels. J.J. Abrams' company Bad Robot will reportedly produce the film based on Mattel's toy car brand. Thomas the Tank Engine. Set to be directed by Quantum of Solace director Mark Forster, the movie will be a mix of live action and animation. Rock'em Sock'em Robots. Vin Diesel is set to star in a live-action movie based on Mattel's two-player action toy. And Viewmaster. MGM and Mattel are reportedly teaming up to produce a live-action movie about the stereoscope toy. If Barbie or any of the Mattel films want to be the queen of the box office, they'll have to take down Hasbro's Transformers, the highest-grossing movie series based on a toy franchise.
Welcome back to Yahoo Finance Live. Let's take a look at some of the movers here after hours. 3 stocks for you. Let's start off with Intuitive Surgical. This is the robotic surgical company here, provider of equipment. That's under pressure in after hours trading, off just about 5%. When it comes to the numbers for its most recent quarter, actually beating the street's estimates on revenue. Procedure growth was up 22%. The company saying that more surgeries helping its results. But we got to remember that this stock has certainly been on fire since the start of the year. We've seen a massive run up as of late, up just about, this is serious. Let's go over to Intuitive Surgical. Here we go. A massive run up as of late, up just about 31% year to date. So it's giving back some of those losses there. We mentioned the fact that for some of these companies, the bar is very, very high, especially when we see gains over the last couple of months. So that's why we're just giving back some of that excitement, at least right now, off just about 5%. Flipping over to CSX Corporation, the railroad operator, that's also moving lower, off nearly 5%. The company missed on revenue. It was down about 3% from just about a year ago. Falling coal, fuel prices, hurting sales, also weaker shipping volume, something that we have talked about industry-wide. That is weighing on CSX's results here for its latest quarter. Year to date, the stock is still in the green, up just about 8% over the past year, up about 13%. But again, the fact that it fell just a bit short of analyst expectations, that's what's putting pressure on shares right now. Rounding out with Capital One, a look here at the consumer, credit card spending trends, auto delinquencies. We're actually seeing a rise of just about 0.5%. Deposits did slightly miss expectations. Also, the company reporting higher auto and credit card delinquencies, something that we have really been closely tracking here as we get a number of results here from the credit card companies, from the banks. That's offering us a closer glimpse, a closer look into what exactly the spending behavior is right now. Over the last 3 months, looking at Capital One, up just about 18%. Since the start of the year, up about 23%.
Well, it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Home buyers getting a little relief on rates. The 30-year fix edging lower over the last week, now at 6.78%. But lack of inventory is a big concern. Existing home sales fell nearly 19% in June from a year ago. It was the slowest pace of sales since 2009. American Airlines was a top trending ticker on Yahoo Finance after the company reported strong earnings, but guidance hit the stock. While American raised its full-year guidance, some analysts say there were some details about pricing power that spooked investors. The stock was down more than 6% on the day. Dow component Johnson & Johnson reporting earnings this morning. The healthcare giant reporting better than expected earnings and revenue, also raised its full year guidance. J&J seeing strength in its medical tech business, and the results come amid concerns about the thousands of talc-related lawsuits the company faces.
All right, well, that does it for us today on Yahoo Finance Live. Ali Canals, first time anchoring. Ali, I didn't want to put too much pressure on you at the start of the show by calling it out, but awesome job. You got to come back.
Thanks for having me.
And visit us again. All right, guys, that does it for us today on Yahoo Finance. We'll see you right back here again tomorrow. Have a good night.